Do you think they care? They just print the money.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. We have exclusive interviews and access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Morand, and I'll be your host for this week's episode, and we'll be joined shortly by the one and only precious metals expert and whistleblower Andrew Maguire as we pull back the curtains on the intricate world of the gold and silver markets and expose what's really going on in the precious metals industry. And get ready for another blockbuster episode of Live from the Vault right here, and we'll bring you the knowledge and the understanding that the mainstream media just won't provide. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, we've just closed off the first quarter of 2024. And as you can imagine, we've had some great shouts from the subscribers and from our community mentioning how the first quarter gold targets that you presented at the start of 2024 played out just as expected, closing over $2,000 per ounce higher than where we opened in the beginning of the year, as you remember. Can you update us on what we can expect moving forward now?
Hey, Shane, great to see you, my friend, and great to be with everybody again. These important updates. Let's get going here. There's a lot to get through. But yeah, Shane, this is a great place to start. This is what I'm kind of hoping to cover in this episode, though. A look at the first quarter, gold and silver footprints, really, and that's to guide us for a forward view, a second quarter prediction, and beyond, and why the Fed has to fold its gold suppression hand. So these are the main things I really need to cover. So let's kind of start with what the supply and demand footprints tell us. As very short-term volatility aside, these footprints ultimately trump every single other input, whether it's the perceived interest rate trajectories, flip-flop Fed speak, see it all the time, whether the dollar is rising or not against its rival fiat peers, because don't forget that even though gold and silver are crosses against the dollar, it's really the focus. It's kind of dislocated. The focus is really against looking at the people say, oh, the dollar's rising. Yeah, but it's rising against the other fiat currencies. So quite simply, it is the global physical market supply demand fundamentals, which is what we try and bring to you, that ultimately drive the price. And it's especially relevant to Basel III compliant first tier gold. Ultimately, it also influences the joined at the hip silver, and that's why we really track them so closely. Now that we've concluded the first 3 full months of first quarter of 2024 gold, it's the 3rd of April today, and also, of course, silver trading as well, in order to really best assess what to expect as we now focus on what to expect by the end of the second quarter, let's first step back to look at the first quarter, the footprints really, that have led us to hit our expected first quarter higher stair-step targets. And this is exactly what we're trying to do again. So let's start with gold, and then we'll take a look at the lagging silver market, which ultimately, and when I say lagging, yes, we've seen a bit of a rally, and we'll explain why, but really, why isn't silver? We asked this question last time. Why is it that silver is not trading? Gold's trading at all-time highs. Why is silver it's not exceeded its all-time highs? So, and silver, we ultimately expect to outperform a very strong gold market in this next quarter. And while we commenced gold trading on the 2nd of January, spot gold was trading at 2,055.60 it was in spot terms. And as we assessed in our 1st of January Live from the Vault episode, which was on the 10th, and the title, I mean, pretty much the title of that episode says it all. Because unbeknownst to the led by the nose COMEX-centric CTA sellers, a golden bear trap had been baited for them to fall into. And as we reported at that time, our liquidity providers had reported very large central bank sovereign spot gold bids were actually aggregated in large tonnage size as about $50 below the opening market price, which we'd identified had already been established as the next higher stair step for gold to rally off into the end of the quarter, which was just pretty much what happened. And these massive central bank sovereign physical orders were layered at exactly spot 2000. Now, the reason we drew attention to this massive central bank support level was to counter the many calls referencing we had a rising dollar, and then there was people were saying it's sufficient to see gold retrace back into the 1860 area. Remember, we talked about this number over the period of time, all through January, most of February. People were saying, no, really watch out above. Here it comes. We're going to see a retracement. Now, while technically, if that had gained required traction, self-fulfilling to a certain extent, first-year liquidity providers estimated that actually a dip into the central bank bids at 2000 would actually be very short-lived and presented a massive, huge opportunity for us to buy gold at a price that will never be revisited. And at the open of January trade, we were experiencing the strong dollar rally. It told us that the automated, those inverse spec CTA synthetic gold futures sellers. So in other words, dollar goes up, they sell gold. Ludicrous, because they don't realize it's dislocated. So we figured this would present a huge opportunity for central banks to unload this rising dollar price into cheaper gold. And that by being a little patient, which we said at the time, and for us to also then coattail them in exchanging these higher priced dollars for physical gold. And as we reported, the liquidity providers had assessed that should this central bank spot 2000 bid level be offered in the synthetic markets, which it was, it would be quickly filled and it would force insiders exposed to a wall of NSFR delivery obligations, compliant delivery obligations, to commence a strategic unwind of their short bets against gold far, far earlier than they had actually hoped for. And this played out perfectly for the central bank bidders, badly for the insiders. And the reason we look at these footprints now is that we see a similar opportunity being presented at higher levels as we now enter the second quarter trade, with the dollar flirting actually very close to the same 105 level that we experienced when a $200 end of quarter rally began on February the 13th. So you can look at any chart and you can see that. And so really the 105 level, the dollar 105 level, I mean, to provide context really, and it's important to do this, so because the dollar had risen from 101 to 105, and as I say, on the 13th of February, and the CTAs had blindly entered into this gold bear trap, and it was sprung the moment they overshot the spot gold central bank bids at 2000. Unbeknownst to them. In fact, our liquidity providers are somewhat surprised the cartel insiders had not front run this central bank buy trigger. And as was evidenced into the flash dip and rebound, it suggested they had actually misjudged the scale of the momentum that these CTAs had actually generated. And as we've previously assessed, and it's backed up by the Bloomberg report we uncovered in a recent episode, these CTAs control about 75% of the synthetic undeliverable open interest, and they drive the paper oil, gold, silver positions, both long and short. And it was this herd of momentum-driven sellers that triggered this central bank bid level to be actually hit. And while it was the trigger point for the cartel to commence an actual short rinse of these bear-trapped traders, there was insufficient cover for them to profit from this rigged trade. It backfired. And a small clue was the massive over 12,000 EFPs that very day, which is over 37 tons of COMEX gold. This is a big EFP. This is the exchange for physical mechanism that allows the exiting of COMEX synthetic gold into the NSFR compliant deliverable markets. What this did was actually converted this huge EFP, and this is a very notable size because it's unusual to see that kind of a size. But it really what it was the actual COMEX open interest being converted into compliant bullion for delivery that day. It's a T+2 delivery situation. So the reason these official price rigging the reason it backfired, it was the perfect storm for the spot T+2 delivery demand, which is we've talked about before. That it means you put a spot order in, and in the over-the-counter markets, they have to be physically backed under the compliance, and they have to be delivered within 2 working days with a very small premium. So these demands were triggered into the dip below 2000 spot. And it was compounded by this sudden COMEX EFP outflow flowing into this NSFR compliant deliverable foreign exchange gold markets in London. And what it had done is it forced the full funding. Remember, COMEX positions are only 7% backed. It forced the full funding of these 7% CTA COMEX contracts being demanded for physical delivery. Officials and their agent cartel insiders were caught severely wrong-footed. And I mean, just note the later reported repayments of Fed-borrowed BIS leased gold. Remember, that happened. It was a delayed report, but it coincided with this repayment. Now, not all EFPs result in deliveries, and some flow into the GLD ETF flywheel, which is exchangeable with COMEX open interest. But either way, these are either bullish additions or repayments of borrowed ETF previously sold short. Now, we covered this in detail in our last episode, so I'm not going to dwell on it again, but to give an idea of scale, these COMEX outflows into the over $200 rise into the end of the first quarter totaled 281,255 lots. That's huge. That's 875 tons of NSFR compliant bullion. I mean, that's a quarter of 2023 global mine supply on a one-way trip out of the COMEX casino just in this first quarter, just in the EFP market. And that is mirroring what's going on elsewhere, just to give one a clue. So to answer your question, Shane, from the opening of trade at 2,055.60 spot into the end of the quarter, which was spot at 2,265.60, and it's risen since then, but we're just dealing with the first quarter. A physically driven $210 per ounce rally had been locked in by central bank buyers, hitting and slightly exceeding our first quarter gold projections of 2,200. Now we're going to look at a similar higher stair-step setup for the end of the second quarter in a sec.
Hey, Andrew, you had mentioned that you expected the Fed to be forced to fold its gold suppression hand. Can you expand on this, please?
Yes, Shane. Now, following losing control of the central bank-driven gold price during the first quarter, this will be the quarter where the Fed, the single outlying central bank still fighting the price rise in gold, has to fold its naked short gold and has to. Central bank demand is simply too strong. And I'm talking about global central bank demand. It's simply too strong. And the Fed doesn't have the bullion to deliver into a wider global central bank sovereign race to swap their fast appreciation dollars for real bullion. And without enough COMEX speculator held open interest, in other words, the chips in the casino, to offset official short bets against gold, Basel III and SFR conditions enabling the conversion of synthetically priced COMEX gold have made it impossible for the Fed to continue to shoot itself in the foot. It doesn't have the bullion. Not only have we evidenced central bank sovereign and institutional demand explode, it's the increasing percentage of commodity trading advisors, speculators, who now also recognize Basel III NSFR gold as an alternative first-tier asset class to hedge risk trades. And what's that doing is, even though that's a paper trade, that's diluting an ever-declining open interest for the Fed to successfully game. Now, in an attempt to repay the remaining Bank of International Gold swaps and borrowed GLD shares, this leaves the Fed constrained as to how many paper market CTAs they can suck into puking up their recent long bets, which do comprise an element of what is driving the current gold rally. And we should expect attempts to do so, but this will be limited in scope as all dips offering opportunities to swap dollars for gold are being jumped on. Now, even the mainstream media is waking up to that. Not only have COMEX gold stocks open interest, in other words, chips, supply in the COMEX available to be traded, not only have they contracted by half over the last 4 years, BlackRock and JP Morgan recently said gold has been the go-to hedge for most portfolios. I mean, you can't deny it. And these are the sticky longs we've been drawing attention to, and they are using gold as a first-tier alternative hedge to their active risk positions. So yeah, they're embedded in the paper markets. Some CTAs are not authorized or don't have it in their mandate to own physical gold. And so they will buy an ETF, they will buy paper gold. But what we're saying is these guys are not rinsable. And as we've recently drawn attention to, interestingly, and just as we predicted, we see the Fed beginning to switch tactics, trying to inject volatility into Bitcoin, which has now come into the frame for as an unwanted dollar benchmark. So it's under 3 months, and there's 11 Bitcoin ETFs, and there's about 59 billion of assets under management just within this inflow within this 3 months, and they're growing exponentially, and it's averaging around about 130 million a day. And we did an episode about this, but it makes sense. Fighting a losing battle against every other central bank seeking a higher gold price to back their respective currencies, and notwithstanding the upcoming alternate BRICS payment systems, the Fed battle tactics, they just have to change. And through the employment of position concentration, aggregated within the sanctioned Bitcoin ETFs, the plunge protection team, who is the team that manages the dollar against all the other crosses, can use this concentrated positioning to inject volatility just as they have for decades in gold, usually at and around news events to target visible stops. So they can do the same thing in the Bitcoin ETFs where they know the stops. Of course they do. And a lot of these guys are behind the financing of it. And in the process, they're also injecting volatility into the Bitcoin. And that's something the COMEX was formed to do 50 years ago in gold. But Bitcoin is really just another competitor to the dollar. And given the Fed acknowledges intervening in all the foreign exchange crosses, it becomes far preferable to short to short and then buy back synthetic Bitcoin against speculators than selling paper gold, which then they have to turn into physical and then buy it back. So it's far more preferable to short Bitcoin and then ultimately, because NSFR compliant gold has to be physically delivered, and they don't have it. So this is really the focus now, and it's also a losing de-dollarization battle, because probably Bitcoin will continue to rise. And do you think they care? They just print the money. In other words, they don't have to deliver physical gold, which they don't have, but they can print. They're eminently able to print dollars. So it's a slow exit point, but it is a change in tactics.
Now, Andrew, you'd mentioned that you had assessed some of the higher stair steps which should be watched. Can you share with our community what these stair steps are, please?
Yes, Shane. So what we're saying is, while we will experience intra-month, intra-quarter Fed-induced volatility around Fed speak and news events such as non-farm payrolls on Friday when this episode is released, as we did throughout the first couple of months of the first quarter, we now see a similar bullish, higher stair step set up to mirror the first quarter trade, but from a higher level. This time, liquidity providers report the fresh aggregation of large central bank sovereign institutional limit order bids sitting in spot gold, providing an anchor which is actually over $200 higher than was evidenced on the 13th of February. It's quite a big deal, this. And this time, the anchor or the central bank bids are sitting at 2,200, which is plus or minus a futures price of 2,220 because of the June contract. And obviously the carry cost for the June contract. Now, we can report that there are some very big physical orders aggregating there. And if they are front run, they will move higher. Now, having been caught wrong-footed into a dollar rally into February the 13th, and that the dollar is currently plus or minus at a very similar 105 level now, and there would be some non-sticky spec vulnerable to a long stop rinse, liquidity providers would be surprised if insiders dared triggering too much CTA momentum-driven selling that could really, due to another tonnage, what it could do is create another tonnage-sized wall of forced unwinding of what is a 93% casino leverage. So in other words, forced to take these 7% funded positions and add 93% to fully fund them so they can be delivered. Now, that's what caused them the problem last time. It presents the cartel who got wrong-footed last time a case of be careful what you ask for. So if these higher stair-step central bank bids are not hit or are front run into what is anticipated to be a politically sought non-farm payrolls headline beat, all non-farm payroll beats are politically sought as we move into the election time. And even it's the quality, and even those beats, it's the quality of those beats, which is completely missed by the headlines. So really, we probably will see that. And if they are front run and we don't see it, then we would raise this stair-step support level to 2250, which is 2270 June futures. Now, don't count out the ability for the PPT to rinse out those that they can. So it's possible that we do tag it, and that would be a huge opportunity at 2200 spot. Now, one last thing. In our January first quarter predictions, we'd assessed that it was possible that gold would be revalued higher by the end of the first quarter. However, while this has not been formalized, we haven't seen that yet, as can be seen by the footprints, this is occurring by stealth under the noses of the mainstream media analysts. And as we progress through each quarter of 2024, it is the well-adopted Basel III NSFR compliance that is underpinning this 10 times larger spot gold market for the sole reason because gold has been reclassified as the real money it is, providing every global central bank and sovereign entity a perfect, live, tradable foreign exchange de-dollarizing instrument. It escapes many people to realize this. And as we've assessed in all our first quarter bi-weekly episodes, this is going to continue to be the story of 2024. While most will be surprised by each new fresh all-time high and will be caught light of bullion into an inevitable gold price revaluation event, we will all be looking at this ultimately in the rearview mirror. Every global South central bank, bar none, as well as European and Asian central banks, are positioning to revalue gold. And during the last week of the first quarter, we noted a distinct change in behavior around the Asian-centric AM gold fixes. So that is at 10:30 UK time. And this is usually a lighter fix. It's usually represented by Indian buyers, etc., who have pretty much gone off the boil for gold because of the price rise and are really stepping up their silver buying. No, we're evidencing massive Chinese buyers populating this fix. Complete change in behavior. Each time, this has been followed by the usual COMEX pit open sellers who then found themselves later being picked off by these dip buyers into the next higher AM fix. This is a change in behavior, and it will be spooking the paper gold cartel's mantra of literally selling every pit open in the hope they can aggregate enough coattailing CTA behavior to reward these hangers-on to assist in this self-fulfilling capping effort. It's not going to work. And as a note, though, China will be absent, though, on tomorrow, which is Thursday, and Friday. So the AM fixes may be thinner. And of course, they've gone for the day on Wednesday by this time anyway. Now, we'll look closer. So that could present some opportunities. Now, we'll look closer at the revaluation process as the weeks do play out. But one thing is clear. It was the commencement of the 2023 trading when Basel III NSFR regulations forced spot gold into a physical market condition that, in spite of official gold market interventions against the dollar, gold against the dollar, gold against gold versus the dollar, that gold would still and has to be valued hundreds of dollars higher now and in the future. And it's inevitable by the end of the fourth quarter of 2024, spot gold will be plus our minimum 2,500 spot level. And most physical market liquidity providers are now gravitating to closer to $3,000 per ounce, to which we also subscribe. These are really conservative estimates, and they still don't do justice to where gold should be regarding other fiat currencies.
Andrew, in our very last episode, only 2 weeks ago, you drew attention to the upcoming BRICS summit. Can you update us on what you expect to see from this?
So yes, Shane, this is actually raises the revaluation trigger, possibly forcing a reaction from Western central banks to up the ante and before the end of the second quarter. So, and start to think about revaluing. This could be the trigger point. And the focus is on the BRICS 10 plus meeting, which is the May 14th to 19th Kazan summit next month, which is literally only 3 weeks away, where following current beta testing, Glazier's green-lighted BRICS currency baskets will be formally tabled. Now, while many will continue to underestimate the bullish gold effect of this alternate trading currency, it is because most are focusing on the SDR-like currency basket, which, due to the current array of dislocation of of the BRICS 10 FX currency imbalances, it would take years to significantly accelerate the de-dollarizing process. However, the lion's share of the green-lighted currency is the second of Glazier's two currency baskets, which is backed by commodities and gold. And as we reported last time, the clue that this is the preferred of the two currency baskets and that the lion's share will utilize gold and hard commodities. Yes, and we said last time, this actually may include silver. I can't be sure of it, but it could easily do. And what really drew us to it was the statement by the foreign minister, Sergei Ryabkov, that this currency will more effectively, and as he put it, he said, use the available resources of the countries in mutual settlements to avoid losses due to differences in exchange rates. Now that could actually, with the yuan depreciating today and at lower levels, possible revaluations there, it really makes an awful lot of sense. This is the currency that makes sense. And especially as China and Russia and the BRICS countries have the gold. Now, given the BRICS 10 members, plus members, that is, control the lion's share of the multi-trillion-dollar oil and energy complex, the scale of this upcoming de-dollarization process just should not be underestimated. In fact, one of my most respected liquidity providers, very closely associated to the Russian-Chinese markets, sees very recent geopolitical escalations, and I'm talking about over the last 2 weeks, and the increased weaponization of the SWIFT clearing systems to seriously bring forward the implementation of Glazier's gold-backed commodity currency. And given the scale of this, $3,000 would then become the bottom of their range assessments. And a gold commodity backed BRICS currency will significantly raise the dollar price of energy and oil, feeding an unwelcome inflationary input right the way into the West. It's just not appreciated. And to put things into context, ultimately, it's not that the gold price is actually rising. It's just actually the depreciating purchasing power of the bankrupt, debt-laden dollar and all its related fiat cousins. It's en route, slipping to zero against gold. There will come a point, as we've said before, where no amount of dollars will buy an ounce of gold. And think of, I always just bring to mind the wheelbarrow of printed Deutschmarks it took to buy a loaf of bread. In fact, at one point, it was just really used for warming fuel. And given current geopolitical escalations are accelerating, Russia and China's efforts to open up fresh sanction-proof trade routes and clearing systems, this de-dollarization process is rapidly expanding, escalating, and none of this is yet factored into the paper price of gold. And we would expect to see the first central bank gold revaluations actually within this second quarter. There's a lot going on. And while we're on track to hit a minimum of 2,500 spot, and think now this comes forward to the end of this second quarter, our extremely well-connected liquidity providers are indicating all the pieces of the puzzle are in place and that $3,000 gold looks magnetic.
Now, Andrew, my favorite topic is silver here, but you had mentioned that silver's underperformance versus gold. Can you tell us what you're seeing in the silver market now?
Silver has been a laggard, as you well know. And this is a direct result of the cartel's capping efforts. While all other asset classes were rising, by design, the retail silver market collapsed into this outrageous capping. But while this fooled silver investors to dump their retail silver, and they were, the wholesale market was deliberately being starved of supply, driving this unprecedented retail to wholesale disconnect. And this capping related to massive first quarter cartel bets that they'd made against silver futures at $25. Lo and behold, it closed below that level. But what happened the day after? And as we drew attention to in our last episode, though, look, please review that analysis. Capping $25 into the wholesale shortages forced the cartel to borrow SLV, like SLV ETFs, at huge premiums. Remember, they went through the roof. And as soon as the first quarter bets were squared last Thursday, the massive coil disconnect between the resulting lackluster retail demand versus massive wholesale shortages began to uncoil. Now, first-tier liquidity providers assess that silver will outperform gold during the next quarter in a dramatic way, even though gold is rising. And as we previously assessed, silver has wholly different trading dynamics. COMEX silver futures, when we get an EFP, they're not NSFR physically deliverable, so they're largely pointless. And as these unallocated silver flows, they just end up circling back into the cartel's hands in unallocated form. But Indian buyers are directly accessing COMEX silver futures positions and forcing physical delivery at the COMEX vault back door. The larger wholesale buyers are also tapping silver ETFs, exchange-traded funds, for supply. This suggests the current OPEC structure is actually skewed against the insiders who have, through the whole of quarter one, been aggressively capping $25. But given the drain of registered COMEX silver stocks are exiting the COMEX ring fence, the result is a forced deleveraging of COMEX open interest, forcing a 93% paper covering obligation on the cartel because it's coming out the back vault. They don't have normally in an EFP, it would go through to an unallocated position. It would never have to be fully financed. It'd be just netted out amongst the daisy chain of bullion banks, of cartel bullion banks. But being someone backing up to the back door forces them to actually fully fund these contracts. So the large tonnage size SLV outflows that we've reported in our last episode were literally being borrowed to flywheel this demand. But these borrowed SLV shares have to be repaid. And while the targeted hot money rinses have relieved certainly some of the stress, Indian buyers, starved of spot silver supply, have turned on the COMEX for this physical delivery. And given the shortages of available registered COMEX inventories as well, it's doubtful there's sufficient speculator open interest to keep a lid on the extremely tight for supply silver market during the second quarter. And as we assessed in the last episode, we've been looking for a breach. And remember, we mentioned this was the number that we were really looking for, a breach of the $26 and 26,225 level, which is what we believe is, and all our liquidity providers believe, this is the last line of defense for the cartel. And although we breached it in Asia overnight and went through it, this is Wednesday, expect a fight, but a pit close on Friday after non-farm payrolls. Above that, it will open up a very large short squeeze rally. Now, this rally, when it takes root, will be physically driven, also having exposed themselves to the most outrageous denial of supply shenanigans into thousands of tons of unfilled refinery orders. Really, end users are increasingly going to the mines themselves to cut out the cartel's control. And while we have further evidence of this, Rob Kientz provided us a great example of Tesla directly financing a Mexican miner to obtain direct supply. And by cutting out the cartel's financing hold on miners, they will increasingly lose control of the capped silver market. And as we've said, pigs get fat, hogs get slaughtered, and the cartel's greed has put them in the frame for this ultimate demise. Direct financing of silver projects has picked up significantly. And we're going to obviously update you more on this very, very soon because there's a lot going on here. The current setup suggests it's going to be impossible for the cartel to hold silver back from catching up to mirroring, joined at the hip, all-time gold market highs. And we are very, very close, as we said last time, to this inflection point that will drive a similar to gold, physically driven rally in silver. So to kind of sum this up, the 26,225 level, $26.22 level, is the watched inflection trigger. And given the underlying refinery shortage into unprecedented strong demand, liquidity providers are predicting this to be the last cartel defense line before silver mirrors gold's all-time physically driven high. It is going to move very, very quickly. We saw it in March 2020. You watch this time. So really what we're saying is gold or silver, they're both in strong, massive demand as we progress through 2024. I guess the question is, how are you doing? Are you well positioned for this? It's going to take a significant amount of dollars, pounds, euros, etc. to buy the same ounce. Even if it's just one component of a wealth protection strategy, there is only one question, guys, remaining. How much physical do you now own?
Thank you, Andrew Maguire, for talking gold, and to all of our Live from the Vault community members. Remember, buy physical, buy only physical. Make sure it's backed, 1-to-1. And understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. You heard it right here on Live from the Vault. And there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. Please help keep spreading the word about this channel by hitting that like button. Hit it right now. Hit that like button right there. Share this information. And also, you can subscribe if you haven't already done so. Hit that bell if you want to be notified as each episode goes live. And with that, we'll see you right here next time on Live from the Vault. See you then.